CEOs are saying you got to get back into the office. We're seeing a shift in power dynamics when it comes to the employer and employee because over the last few years, employees had the upper hand. A lot of employers needed workers, they needed employees, and there was a shortage of employees out there. So employers were fighting each other to get employees, meaning employees had the ability to fight for higher pays, they had the ability to fight for better terms. Now you're starting to see that shift. And the biggest shift that we're seeing is in the actual office, where employers are demanding employees to come back into the office. Apple has mandated that you have to come back into the office 3 days a week. Disney says you have to come back in 4 days a week. Goldman Sachs says that you have to come back in 5 days a week. So you're starting to see more and more of this. And there was a new report that came out just a couple of days ago, which said that office use across the United States is now at 50%. Which is the highest number that we've seen since before the pandemic started, which shows that you're starting to see more and more employers ask and tell employees that you have to come back into the office if you want to continue working here. The reason why employers are asking employees to come back into the office is just for productivity purposes. They're saying that you're more productive into the office, you're more collaborative, we can get more ideas in the office, so they're asking people to come back. Now, this comes at a very interesting time because we just got our latest jobs data for January of 2023. And this jobs data came in way better than what was expected. The expected numbers was that we were going to see about 100 and some thousand jobs in January 2023, but we actually saw 517,000 jobs added in 2023, and unemployment levels have fallen to 3.4%. That's the lowest unemployment level since 1969. Now, the reason why this is so important has to do with inflation, because just earlier this week, when Jerome Powell raised interest rates by 0.25%, one of the things that he talked about was the labor market. And what he said, meaning the job market, he says that the labor market continues to be out of balance and that reducing inflation is going to require a period of below-trend growth and some softening of labor market conditions. So, Jerome Powell, who is the chairman of the Federal Reserve Bank, is working to bring down inflation. One of the ways, according to him, to bring inflation down is to loosen and soften the labor market. What does that mean? We need more layoffs. We need more people not getting jobs. And this latest jobs market number came in very strong with people getting jobs. So you can start to see where good news can be bad news in certain instances, because it's good news to see a good job market for the economy. But when you have this high inflation problem, it's not good news for the Federal Reserve Bank, because that might mean that they will need to be more aggressive to bring inflation down, because Jerome Powell, even in 2022, he kept saying that he needs to loosen and soften the labor market. And that's a political way of saying that we need more layoffs. And so we got this interesting news about the job market that is stronger than expected, which kind of brought some positive and negative news to the stock market. First, you saw the stock market fall because now you had investors and traders saying, oh no, that means we're going to see even higher interest rate hikes. But this is where now you have the Federal Reserve Bank monitoring this. And if we continue to see high inflation, if we get another high inflation number in February and before the next Federal Reserve Bank meeting, that could force the Federal Reserve Bank to continue higher interest rate hikes for longer than expected. Now, we've been covering all of this in Market Briefs, which is why if you haven't joined Market Briefs, my free financial newsletter, I'll put the link to how you can join down in the description. It's a free newsletter where my team is breaking down what's happening in the economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read email. It's completely free, so if you haven't joined, I got the link for you down in the description below. But the reason why, now I'm going to tie this all together. The reason why these two things are now really interesting is because we also got some of our latest credit card data. This is from TransUnion, and this came out today. And what they said is that in the fourth quarter of 2022, our credit card debt levels in the United States hit $930 billion. It's just a little bit over $930 billion. That is some of the highest numbers, but also some of the fastest growth of credit card debt ever. From 12 months ago till now, we have seen our credit card debt levels grow by almost 20%. It was more than 18% that we've seen our credit card debt levels rise in just 1 year. Now, the reason why this is so significant is now, if we zoom out a little bit and we think about how does the economy work? Our economy runs on spending. When you spend money, somebody else makes money. The more money you spend, the more money somebody else makes. When you go to Chipotle and you spend money, Chipotle makes money. If you have the ability to spend more, Well, now you can go and buy the double guac. You can go and buy the extra meat. And when you do that, Chipotle makes more money. When Chipotle makes more money, they will have the ability to hire more employees, to open more stores, to invest in more research, to increase their recipe and make their recipe better. But when people are not buying at Chipotle, well, then Chipotle can't do that. What we've been seeing is that companies still have the ability to hire. Clearly from the January report, companies are still hiring people. But on the consumer end, people are struggling to spend. We can see that from the credit card debt. So we know that companies are still hiring, which means companies are still making money, which means people are still spending. But how are people spending? Well, it looks like people are really squeezing themselves in credit card debt to spend, because we're seeing the fastest growth of credit card debt ever. We're seeing some of the highest levels of credit card debt ever. So people are really squeezing themselves on this credit card debt. And this comes at a time where interest rates are rising. Why does that matter? Because credit card debts are variable interest rate debts, meaning the interest rate that you have to pay on your credit card debt is going to vary based off of what's going on with interest rates. Well, earlier this week, the Federal Reserve Bank raised interest rates again. What does that do for credit card debt? That puts higher pressure on interest rates and credit card debt. So we have this highest balance of credit card debt, and that means now that even if people were not increasing their credit card debt balances, the cost to pay down your credit card debt would be rising because there's more upward pressure on credit card debt interest rates. So it's kind of an interesting situation because we're seeing great news on the economic side, but bad news still on the inflationary side, because according to Jerome Powell, the Federal Reserve Bank, when you have this type of really strong labor market, it drives wages higher. When you drive these wages higher, that drives costs higher. People make more money, companies have to pay more money. If companies have higher expenses, they have to then raise the prices of their products, causing higher inflation. So that's why the Federal Reserve Bank is monitoring the labor market, saying, oh no, this is still very strong. The inflation problem still persists, because if the prices of things keep rising, that means inflation is not under control. And if inflation is not under control, that means they have to keep raising interest rates in order to bring inflation under control. So you can start to see how it kind of just comes full cycle, where you want to see economic growth in a sustainable way, where now the economic growth is not contributing to significantly higher inflation. Remember, the Federal Reserve Bank says that they want 2% inflation. Why 2%? Because that's where they feel that it's enough to cause enough inflation without causing a lot of pain to consumers. Inflation now, of course, disproportionately hurts people who are not financially educated, and it disproportionately benefits the people who are financially educated. But this is where understanding that everything is kind of playing in this cycle, and the inflation problem is still there. This jobs report says that while there's good news in the short term for the economy, it is not good news on the inflationary side. And that means that there's going to be still a longer and bigger fight on the inflationary side to cool down inflation, to bring inflation down, which also causes more pain to the economic side. So again, what we're going to be seeing in 2023 is going to be interesting. This whole inflation and economic cycle and game isn't over. This is going to be playing out through 2023 into 2024. So this is why I want you to, one, stay up to date on what's happening. Market briefs can help you with that. But then second, also be financially educated. That way now you can prepare, take care of yourself, and then capitalize on opportunities that might come your way.